Paul Donovan, Deputy Head of Global Economics at UBS, joins me now. So, Paul, I know that you don't think there's a huge risk of a double dip here, but what do you make of this theory that, you know, the economy is moving at such a low level, moving along, that there isn't any worse that it could get? It couldn't go into a double dip. It's already bad enough.
Well, an inventory-led slowdown, absolutely not, because we've had a structural change in the inventory cycle. And it's important to focus on inventory, because about 70% of a recession is normally inventory adjustment. But when we actually look at the economy is doing all right. It's not doing fantastically, and it's disappointed some consensus expectations, sure. But you've got positive growth, it's coming in roundabout trend, you've got some job creation, you've got rising incomes, you've got rising industrial production, you've got accelerating industrial production indeed. You know, it's not anywhere near a double dip. This is nothing like.
Now, we've got a big jobs figure coming out of the US tomorrow. What are your expectations there?
I don't think we should be looking for too rapid a pace of jobs growth. That's not what we're going to be getting. What we're getting is a very moderate improvement in terms of absolute employment levels, but the hours worked of people who have got jobs, that's been going up nicely. The income, the average hourly earnings of people who've got jobs, that's been tending to go up. So what this is basically creating is a split, a schizophrenic society. If you've got a job, you're fine. If you haven't got a job, it's pretty bleak, to be honest.
There's no way you're going to be going out and buying a car if you don't have a job, or if you think that you might lose your job, indeed. Now, Ben Bernanke was pretty emphatic. The Fed will do whatever it's going to take. Does the Fed actually have the tools, though, should the economy dip even lower?
It does have plenty that it can do. It can continue to provide additional liquidity. It can broaden the range of purchases in asset markets. If it needs to, it can do a great deal. What Bernanke was saying was, yes, you know, we are ready to do whatever it takes, but we don't think we have to do anything, particularly at this stage. And the Fed was actually being very, very clear about this. In particular, Bernanke is effectively saying we will not adopt quantitative easing. We will not go out and try and deliberately raise inflation expectations with a quantitative easing policy. We'll carry on with quantitative policy, that's printing money, but we're not going to try and raise inflation expectations, which is quantitative easing.
Printing money. How long is the US going to get away with not having a clear plan for reducing its deficit?
Well, at some point, the US government is going to have to come up with a scheme for controlling its deficit. But bear in mind, we're talking about the world's reserve currency, and there aren't many other attractive options out there if you're a central bank trying to invest your foreign exchange reserves. The dominance of the dollar as a reserve currency has been re-established. So there is demand for bonds. The other thing that's worth bearing in mind, of course, is that the federal government isn't just spending money for the sheer joy of doing so. There is actually a private sector savings boom, which is providing funds for the bond market.
We've got to talk about the ECB. Should the ECB be doing what the Fed's doing and saying, look, we're going to do whatever is necessary? You had Weber saying that they would keep in crisis mode until the first quarter of next year. What are we going to hear from Trichet today?
Oh, well, I think we're going to hear that again. I mean, economics dictates that that is sensible, and the fact that Weber's sort of pre-announced it anyway. They're not, I think, going to withdraw the emergency measures. They're going to continue them for the remainder of this year. I don't think we're going to get a great deal else, to be perfectly honest. I don't think there's going to be any particular change in tone. There's certainly going to be no change in policy. No one is expecting anything along those lines. So in terms of the actual policy, I think it's more of the same.
Okay.
What might be interesting is the comment on the growth divergence you mentioned earlier on.
Okay, we're going to have to leave it there. Thanks very much, Paul Donovan.